Good afternoon, ladies and gentlemen. A bit of a pause in the market after a massive rally of about 2,400 points on the Nifty. Today is also the weekly expiry of the Sensex. There is a heavy resistance that the Nifty faces around 24,400, 24,500, and that is what is being negotiated between bulls and bears. Metals and defense are the two top counters that are doing extremely well on the markets as far as the long side trade is concerned. Pharma is in top shape. Stocks such as PPL Pharma are up 7%. There is strong gains coming into Praj Industries from the ethanol space, and of course you have Oracle Financial Services and Data Patterns in top shape. So that's the state of play as far as markets are concerned. But let's take a look ahead and speak to Mr. Rajesh Sehgal. He has a history of managing the public markets via Templeton India and is now the managing partner at Equanimity Investments. This is a PMS company which takes stakes in unlisted space. Good afternoon to you, Mr. Sehgal, and a very warm welcome. How would you characterize sentiment at this point of time? Is the easy money already made?
The way to look at this from my point of view is there is no easy money in the market. It's a very, very narrow window where you have easy money. And I think the way I would characterize that is easy money is made when, everything is going up. So it's like a crazy bull market. We saw that a few years back. And as I said, that's a very narrow, short window. But I think predominantly life in equity markets for all of us is more of trying to find out some place where you can get an alpha, whether it's a sectoral bet, whether it's a stock specific bet, etc. As of us speaking now, I think there are a few things that I can I would like to share. I think first is that the earnings-led comeback after this painful reset that we've seen is real. Most investors believe that the last 15 months of underperformance and derating, have really helped in setting it up now for a strong recovery. Valuations are pretty reasonable, though they're not like very depressed. They're also not very expensive as they used to be. Uh, Earnings are bottoming out, and we've seen some early numbers come out. Some numbers last quarter, and now some pretty good numbers this quarter as well. So earnings are expected to grow maybe early double digits over the next couple of years. Uh, and I think to cap this all up, you have very strong domestic flows, even though FIIs keep selling. So I think the market is poised at a pretty interesting juncture. It's being swayed in both directions because there are as many positive as there are challenges. And I think it's therefore a pretty stock specific market. So to answer your question in a short way, the easy money is not here.
Fair point.
It's not going to be easy to make money in the markets.
Fair point. Uh, let's look at how valuations are likely to stack up in the fourth quarter earnings that are upon us. Ideally, what should be the bias ahead? Is this still a large cap market where you would want to buy stocks making up the Nifty, or would you also have some kind of a view that is coming in on mid caps and small caps?
Yeah. No, I think that I think is the quintessential question that every fund manager, portfolio manager is dealing with. I think the era of just buying the index or momentum is over, as we alluded to earlier. Large cap stocks look fairly valued, while many mid cap and small caps have already corrected sharply. Returns will come from bottom up stock selection in domestic cyclicals like financials, autos, industrials, and not broad sector bets. However, you have to, there's always on the other hand. So this is on the other hand, there are enough and more indications out there that large caps could face pressure if the FII outflows continue. In terms of valuations, if you look at the broader Nifty valuations, I think it's about fair from a price to earning ratio of 21, 22, or price to book of somewhere between 3 and 3.5, with a dividend yield in the range of 1.25, 1.27 to 8%. So it's fairly valued to slightly overvalued, and therefore going forward, as I said, the view has to be that it's a stock pickers market. You can't just buy and hold. The damage to market breadth that happened in the last 15 months has created a clean base, and domestic retail money is also, as you can see, becoming far more selective. So it's going to remain a stock pickers market.
Fair point. Metals have been shining dramatically as far as the last 2 or 3 weeks are concerned. The Nifty metals index is at a record high. Aluminium is in top shape. Steel is doing pretty well as well. Would you imagine that the best is behind us as far as gold and silver are concerned? How would you be allocating fresh capital to these two spaces as a part of your overall asset portfolio?
Right. So I think when it comes to gold, from an Indian standpoint, it becomes a little bit of a sentimental call rather than purely fundamental driven call. And I think in times of stress, in times of uncertainty, as we are facing now globally, not just in India, I think gold remains a go-to asset. So does real estate, and we've seen this behavior over decades. As Indians graduate and move towards the higher end of the wealth spectrum, the first few things from an asset allocation point of view are typically house and some jewelry, gold jewelry. So I think realty and from metals point of view, at least gold should continue to do well. As far as silver is concerned, that's more, I would
Okay.
put silver in the bucket of broader metal, like you alluded to, copper, aluminum, everything is done well. I think the metal index, if you see, is trading, I think, 25 to 30% above, fair value, or at least above the 5-year median. So it's not cheap at this point in time. But gold continues to do well.
Fair point. Uh, a view that you might have on interest rates at this point of time, we've seen the RBI grappling with very high possibilities of inflation moving up because of the energy matrix going against the economy at this point of time. How would you
Yeah.
think RBI would be as far as rates are concerned over the next 6 to 9 months?
Yeah, I think that's a bummer and very unfortunate for us because, as you know, markets were poised to expect interest rates to be cut, and there were certain not just noises but sound bites from powers that be that we should expect some interest rate cuts this year. However, given the backdrop of the ongoing war and the impact that it has on India, because we are essentially a crude importing country, completely reliant, or to a very large extent, 85% reliant on imports of crude, both in the for crude oil and also in the fertilizer chain. So I think the mathematics from an RBI standpoint has gone awry, uh, or rate cuts which were being baked into the market, I think will be very difficult for RBI to execute. And I think if they don't do the rate cuts, there are implications for market valuations. There are implications for earnings of certain companies. There are implications for personal finances for individuals if they're leveraged. So I think rate cuts will play, whether they happen or not, will play a big part in terms of how the market performs over the next 6 months that you're talking about. My view personally is it's difficult to anticipate rate cuts.
Fair point. You've worked extensively with uh, Mr. Mark Mobius, who very recently passed on. and he has been he was an eternal bull for the last 40 odd years on India. He spent a considerable time here as well. What would you think he would have purchased in a market like this in Indian equities?
Having worked with him for nearly 25 years, I first got to meet him in 1999, so it's really been a long time. I've seen him managing investments, portfolio decisions very closely. Uh, I think, if I were to put myself in his shoes, and I can say confidently that, most of us who spend a lot of time with him, whether we like it or not, start thinking like him because he's such a towering figure. He's been such a towering figure for all of us. And I think from his point of view, or from the value investing point of view, this is a market, as I said, it's a stock pickers market. And therefore, investments have to be allocated to areas which look attractive from a valuation standpoint. And it's not today's valuation, you got to really look out 3 to 5 years out. Sectors or companies that today appear pretty expensive, but if they deliver on their promise of earnings growth, revenue growth, etc., become pretty attractive in a 5 year time frame. So from that standpoint, I think some of the sectors really stand out. I think banking is one, real estate is another, and I think the whole infrastructure complex, including not just infrastructure layout but also automobiles. I think these two look good as well. And given what's happening to the currency, given the uncertainties globally, a couple of areas that we would definitely be looking at would be export-oriented businesses. That leads us to talk about IT and pharma. So both these sectors are pretty attractive as well. But as I said, it's not a sector game any longer in today's time. It's more picking up the right stocks within these sectors. So yeah, look out 5 years, figure out, based on your models, which are cheaper companies.
Yes. Fair point. What has been the state of play in the unlisted market in the recent carnage that we saw on listed equities? How have the last 40-45 days been panning out for you?
I think in the unlisted space, it's pretty interesting. On the listed side, you have a daily NAV. So what happened to your portfolio, you get to know every day. I think on the unlisted side, we have the luxury of really thinking a little longer term, which essentially leads you to not be too fussed about what's happened in the last, let's say, a month or 2 months. And I think from an India standpoint, whether it's listed market or unlisted market, the cycles are not intertwined. For example, on the private side of the market, the peak of the cycle was 21-22. And 21-22, as you may recall, after COVID, was just the start of a massive bull run on the public side. So the correlation was pretty low. Given where the markets are today, on the public side, for the last 15 to 18 months, we've seen a significant correction in not just the overall broad indices, but also stock-specific valuations have come off a lot. I think on the private side, we've seen capital allocation going more towards certain businesses that are delivering well on the ground. So private side continues to do well at this time compared to public markets. But I think, as I was saying, whether it is private or it is public, focus is completely on building a business today rather than just fussing over valuations. So on the private side, building businesses. On the public side,
Fair.
delivering on earnings. These are the two things one has to look at.
What has been your most recent investment on the unlisted space?
Interesting. On the unlisted space, we've invested in a company that does a lot of warehouses. And they not only build the warehouses, but I think their focus is more on providing technology that allows them to manage companies, larger corporates, to manage their warehousing pretty efficiently. Another company we invested in recently is a EV battery manufacturer. They've set up a pretty large plant outside of Pune, and and the growth in the revenues, growth in the business it's just been mind-boggling. I mean, the number of orders, the amount of battery power that is required uh, is is, and I think we were very happy till about 2 months back with the performance of this company. But my view now is that given this external shock, the energy shock that India is facing, it's just a kind of wake up call. I think we'll move more and more towards renewable energy, more and more towards creating energy which are non fossil fuel dependent, and that opens up a huge opportunity for companies like Neuron Energy, the company that we invested in. So those are the kind of investments we are seeking, because you look at the overall structure in India. We always say, when you want to invest in India, the good part of the story is that we offer you uh, a multitude of sectors. You can invest in pharmaceuticals, financials, industrials. This is a point that domestic investors in India don't appreciate as much. But when you look at India from a foreign investor's point of view, you really try to understand. It hits you that you have such a variety of sectors. And within each sector, you have such a variety of companies, whether it's large cap, mid cap, or small cap. So that is I think a huge advantage India has. And as investors, we say that no matter which
Right.
sector you look at, there are so many inefficiencies that you can continue building businesses, whether it is healthcare, whether it is education, whether it's infrastructure. You can keep building businesses, and there's enough and more to be done. So the opportunity is huge, both on the private side and the public side.
Right. We'll pause it here, Mr. Sehgal. And ये शुरू से रीत चली आई है कि India looks better from the lens of a foreign investor than from the point of view of a domestic person trying to look and deploy money. Be that as it may, we wish you all the best. And here's hoping that the markets dance to the tunes that you've just mentioned.
Thank you so much. What a pleasure talking to you. Thank you.
Ditto here. Have a nice day, Mr. Sehgal. That, ladies and gentlemen, was Mr. Rajesh Sehgal. He manages an unlisted PMS at Equanimity Investments at Mumbai. Thank you for watching. Stay glued. The market is a bit of a back foot today. Let's hope things improve in the last 1 hour of trade.